Hello everyone, I am Tahsin Sultana, Assistant Professor, Department of Commerce, Government First Grade College, Preseton. In this session, we will be discussing the nature of portfolio management. Under this, we will be covering the topics meaning of portfolio management, objectives, process, and returns calculation. The chapter aimed to understand the portfolio management framework and apply the various theories of portfolio management in designing the portfolio. Students will be able to understand the portfolio management activities. This is the session outcome. In the previous session, we have discussed security trading procedure. So let us first try to understand the meaning of portfolio. Portfolio refers to a collection of investment tools such as stock, shares, mutual fund, bonds, real estate, and so on, depending on the investor's income, budget, and convenient time frame. Now let us try to understand the meaning of portfolio management. Portfolio management implies tactfully managing an investment portfolio by selecting the best investment mix in the right proportion and continuously shifting them, that is, changing them in the portfolio. This is to increase the return on investment and maximize the wealth of the investors. So, portfolio management can also be defined as art and science of selecting and overseeing a group of investments that meet the long-term financial objective and risk tolerance of a client, a company, or an organization or an institution. The art of selecting the right investment policy for the individual in terms of minimum risk and maximum return is called portfolio management. Now let us understand this through an example. Say an investor has 1 lakh rupees to start with and the manager has to distribute this across the investment options. The investment options available to a manager will be real estate, fixed deposit, mutual funds, shares, and bonds. The amount he distributes may be 20,000 in real estate, fixed deposit 15,000, mutual funds 10,000, then shares 35,000 and bonds 20,000. Let us also see the security and the returns which are expected from these kinds of investments. Real estate is considered as an average security investment and returns will also be average. Fixed deposit is a high security investment and the returns are average. So mutual funds an average security and average returns. Shares low security but expected returns will be high. So bonds security will be high but returns will be low. So and a portfolio may consist of these kinds of investment options. Now let us try to understand the objectives of portfolio management. The first and the foremost objective is capital appreciation. So investment portfolio management aims at capital growth and seek for the appreciation of the investment value or the NPV, that is the net present value, is a means of evaluating the actual long-term profitability of an investment or a project through the initial outlay, future cash flow, and time value of money. Now, the second objective of portfolio management is maximizing returns on investment. So, it strategizes the gradual return on investment to create maximum value. To improve the overall proficiency of the portfolio, diversification of funds lead to stability and security against market uncertainties. Risk optimization. So, regular evaluation of the well diversified portfolio optimizes the risk and losses. The next objective is allocating resources optimally. It helps the investors to make the best possible use of their funds by creating the most appropriate portfolio. Ensuring flexibility of portfolio. It provides flexibility to switch from different investment options at any point in time to avail better opportunities. And the last objective is protecting earning against market risks. So diversification of funds leads to stability and security against market uncertainties. Next are the process of portfolio management. The first step in the process of portfolio management is identification of investment objective. So establishing investment objective centers on identifying the investor's risk and return ability. The risk return trade off is the trading principle that links high risk with the high rewards. The appreciation in the risk return trade off depend on a variety of factors, including an investor's risk tolerance, the investor's years to retirement, and the potential to replace lost funds. Time also play an essential role in determining a portfolio with the appropriate level of risk and rewards. So after the identification of the investment objective of the investors based on the various criteria, the next step will be estimation of capital market. Forecasting the future is a hazardous exercise. An investor will have to make informed guesses about the future. To guess what lays ahead, the following factors which drive equity returns: real growth in corporate earnings, inflation rate will also be considered, changes in the price earning multiples, and dividend yield ratio will also be considered. After the estimation of the capital market, the next step will be decision regarding asset allocation. In strategic asset allocation, target allocation depends on several factors. These factors will be these factors will be the investor's risk tolerance, time horizon, and investment objective. Also, the allocation may change over time as the parameters changes. Strategic asset allocation is compatible with a buy and hold strategy as opposed to tactical assets allocation. After this, the next step will be formulation of portfolio strategy. After the decision regarding asset allocation formulated, an appropriate portfolio strategy for each of the component of the portfolio, that is stock, bonds, has to be made. Equity and bond portfolio strategy or a passive or active portfolio strategy has to be selected. After the portfolio strategy, the selection of securities and investment will be done. So selection of bonds, the following factors will be considered like fixed income, yield. First one is yield. The yield to maturity for a fixed income avenue represent the rate of returns earned by the investors. And the next factor will be risk of default. Assessing the risk of default on a bond, look at the credit rating of the bond and then tax shield provided by that investment, that is bond investment, liquidity, if the fixed income avenue can be converted wholly or substantially into cash at a fairly short notice, it is possibly liquidity. So, in equity shared selection process employs three broad approaches: technical analysis, fundamental analysis, and random selection. So after this, the implementation of portfolio will be done. So it involves buying and selling specific securities in given amount. This is the phase of portfolio execution, which is often glossed over in portfolio management literature. It is important practical step that has a significant bearing on investment results. Then the next step is revision and evaluation of portfolio. So revision and evaluation and rebalancing the portfolio. All these steps, revision, evaluation and rebalancing will be done at one stage. After implementing a portfolio plan, the management process begins. This includes monitoring the investment and measuring the portfolio's performance relative to the benchmark. It is necessary to report investment performance at regular intervals, typically quarterly, and to review the portfolio plan annually, once in a year. The investor situation and goals get a review to determine if there have been any significant changes the portfolio, which has to be bring into the portfolio. So these are the steps in portfolio management process. Now the next is returns calculation. Returns will be calculated by using this formula. Here RP refers to expected returns to portfolio. X is nothing but proportion of total portfolio invested in security I. R1 is expected returns to security I, and N is the total number of securities in portfolio. Now let us take this simple problem and try to understand this. Let us assume there are two securities consisting of 20% and 40% ratio. Now securities are X and Y. The expected returns are 12% and 10%. The variance is 25-30 and covariance is minus. Now the expected return will be the proportion and the expected returns will be multiplied and then it will be total. So the expected return is 6.4%. For measuring the risk, the variance is done here. So the expected risk will be 10.44%. I hope we have understood the concept. Thank you very much.